Hello, I'm Jack of all trades, and today I will be talking to you about 9 mistakes to avoid when investing in the stock market. Whether you're a seasoned pro or just dipping your toes into the stock market, one thing is certain: mistakes are a part of the learning process. In today's video, we're about to unveil the 9 common pitfalls that even the best investors can stumble into. So grab your notepads, get ready, take some notes, and let's dive into the video. 1. Not having a plan. Investing without a clear plan is the same thing as navigating at sea without a map. You have no idea what you are doing and where you are going, and you are just hoping for the best. To prevent this, you have to make your investment plan. This starts with defining what your goals are, what your time horizon is, and how much risk you are willing to take. You will have to translate this into when do you want to buy a stock or an ETF, and when do you want to sell it? How diversified do you want to be? When do you want to rebalance? It is best to have answers to these questions before you start. The most basic strategy of buying widely spread ETFs every month could be summarized as: I use a certain amount from my monthly income to buy the MSCI World ETF every month, regardless of the price. I will not sell these ETFs until I retire. In the months leading up to my retirement, I will start selling a portion every month to prevent a big loss in the last month. This plan is not perfect, but it is easy to follow. Make the plan and stick to it. 2. Lack of research. It is important to do your research before investing. Know what you are doing and what your risks are, or you are bound to lose money. Even the most basic strategy of monthly investing into ETFs requires you to know what ETFs are, what compound interest is, and the historical profit of these ETFs. When you want to buy a stock, then it is of course crucial you know what the company does, what their numbers are, and what you think that their underlying value is. If the underlying value is above the current market price, then it might be a good buy for you. If you did not do any of the research, then you have nothing to compare the current stock price to, and you are bound to lose money. To do proper research, you would at least have to look at the company's business model, their financial statements, their management team, the rest of the industry, and other relevant information. 3. Lack of diversification. Putting all your eggs in one basket is usually not a good strategy. You risk losing a big percentage when the particular basket has a problem. Concentrating your investments increases the impact of a negative event on your portfolio. Diversifying means spreading over different sectors, industries, and geographies. This strategy can help mitigate risk by reducing the potential impact of poor performance in one area. An easy way to make sure your portfolio is diversified is to buy widely spread ETFs, like the S&P 500 and the MSCI World. I made a video about investing in the stock market as a beginner that will elaborate on this topic a bit more. 4. Emotional investing. After the basic rules of planning, doing your research, and diversifying enough, I believe that emotional investing is the biggest and the most costly mistake you can make. Emotions like fear and greed can cloud your judgment and lead to impulsive decisions. When driven by greed or the enthusiasm of your friends, you might buy when prices are high due to the fear of missing out, FOMO, or sell during market downturns out of panic. Instead of buying low and selling high, you will just do the opposite. The best thing is to make your plan and stick to it. Don't let emotions get in the way of it. In the future, I will make a video about the impact of emotions and biases on your investment decisions. 5. Using leverage. I don't use leverage when I invest. Leverage can amplify your gains, but it can also magnify your losses. It is important to realize that losing money hits you harder than gaining money gives you pleasure. This is both physically and factual. For example, when you lose 25%, you will have to make 33% gain to get back the original amount. When you lose 50%, you will have to get back 100% to get back to the original amount. The graph shows you the exponential relationship between the percentage lost and the percentage you have to compensate. Using borrowed money to invest can lead to financial distress if your investments perform poorly. Borrowing to invest should therefore be approached with caution and a thorough understanding of the associated risks. Avoid excessive leverage and stick to investing money that is yours. 6. Timing the market. It is already very difficult to predict the short-term movement of the market for experienced professionals. Assuming you're not an experienced professional, I would strongly advise against thinking that you are better than they are and that you will be able to time the market. Instead of trying to time the market, focus on a long-term investment horizon. Investing constantly over time, regardless of short-term fluctuations, takes advantage of dollar cost averaging, which can potentially lead to better average purchase prices and reduced risk associated with market timing. In my earlier video, I went over this strategy. 7. Overtrading. When investing, it is important to be patient and focus on the long term. Many investors believe that they have to act, while the best thing might quite often be to do nothing. Overtrading is not good for you because of two reasons. First of all, by overtrading, there is a big chance that you will sell your winners. Many big investors' biggest regret is that they sold a certain stock in their portfolio, believing it was at its top, while the real run-up only just got started. Let your winners run, don't easily sell them for a small profit. Second of all, trading costs money, so overtrading costs a lot of money. Trading a lot will cut into your profit and will influence your overall gain. In an earlier video, I went over 7 things to look out for when picking a broker. The fees and commissions were an important factor. 8. Ignoring risk tolerance. Investing outside your tolerance can lead to sleepless nights and rash decisions. Risk tolerance refers to your ability to handle market volatility and potential losses. It's crucial to align your investment choices with your risk tolerance and overall financial goals. If you're uncomfortable with significant fluctuations, then go for a more conservative investment approach, even if it means potentially lower returns. 9. Not learning from your mistakes. If your plan is to invest for the long term, then also invest in your knowledge for the long term. When you are investing, you are bound to make mistakes. This is completely normal. Don't worry about it, as long as you learn from these mistakes, so you can try to avoid them in the future. You can facilitate this by writing down what your plan is, what your actions are, and what the result was of these actions. Taking a moment to stand still and reflect is really going to help you improve in the future. So here you have it, 9 mistakes to avoid when investing in the stock market. I hope this video was of any value to you. If you ever made any of these 9 mistakes or want to add a 10th one, then please comment below. Like it if you liked it, and if you want to stay up to date with future videos, then please subscribe. Thank you for watching and see you next time.